Hello, everybody. Just by way of introduction, my name is John Jones, and I am a corporate tax director for RSM South Africa and act as head of corporate and international tax for the South African member firm of RSM. What we're looking to create some awareness around today is the global minimum tax bill that has been proposed by the South African Revenue Services. So just as a starting point, let's have a look at South Africa and the international tax landscape and where we are now and where this all started. And this has been a fairly lengthy journey. And it started with South Africa signing the multilateral convention to implement tax treaty-related measures specific to base erosion and profit shifting. That's more commonly referred to as the MLI. Flowing from that, there was then the implementation of both base erosion and profit shifting actions, and we saw a number of amendments that came through in the South African Income Tax Act, for example, specific to transfer pricing, interest limitation rules that were implemented, and the introduction of legislation around hybrid debt instruments. So, and really the MLI and BEPS then created 15 actions under 3 pillars. And the next step in this process is now what is referred to as the OECD's 2-pillar solution. What is this 2-pillar solution? So again, just going through a little bit of the history. Firstly, we had BEPS Action 1. And BEPS Action 1 was really aimed at addressing the tax challenges around the digital economy. And again, from a South African point of view, for example, we have had legislation around obligations for persons who are providing products or services through the internet, an obligation to register for VAT. Then we moved on to a proposal that dealt with the 2-pillar solution. And then in 2021, there was global consensus that was reached around that 2-pillar solution, and draft model rules for Pillar 2 were released. And I'm going to go into what Pillar 2 means, obviously, over the course of this presentation. In 2022, there were then public consultations, and those were really specific to amounts A of and amounts B of Pillar 1. And there was an implementation package that was put in place for Pillar 2 that was published. We moved to 2023, and the Pillar 2 income inclusion rule is deemed to come into force from December 31 of 2023. Then there's a multilateral for Pillar 2, which deals with what is referred to as the subject to tax rule. And that came open for signatures in October of 2023. And then moving forward to 2024, Pillar 2 under tax profit rule comes into force. And the intention is that will be from December 31, 2024. So as you can see, it's been a long process to really get to where we are today. So what is this 2-pillar solution? So really a brief overview of what the 2-pillar solution is. So firstly, we have what is referred to as Pillar 1. And Pillar 1 is broken down into 3 fundamental amounts. The first is amount A, and amount A looks to reallocate profits in excess of 10% to the various market jurisdictions where there is a nexus test that has to be met. The upside, I suppose, of amount A is that it only applies to multinational enterprises where revenues are in excess of 20 billion euros. and there is a profit of at least 10%. So the assessment that was made by the OECD in this regard is that it will probably impact on about 100 multinational enterprises worldwide, if that. Amount B is something that may well impact on many entities within multinational groups. And what that looks to do is to set a formulaic approach to reward what is defined as baseline distribution activities. And it's really a transfer pricing adjustment that occurs based on certain set parameters. And then amount C really looks to remunerate the additional local activities and provide dispute resolution mechanisms. And that application still is to be confirmed. Now, I'm not going to deal with Pillar 1, and the reason that I'm not going to deal with Pillar 1 is that from a South African perspective, we have no legislation, we have no draft legislation. So how factually Pillar 1 will be introduced within the South African environment at this point in time is uncertain. But what we are seeing is the implementation of impacts that are arising from Pillar 2. Pillar 2, simplistically, sets what is referred to as a global minimum tax rate. And that global minimum tax rate is set at 15%. The intention is that Pillar 2 will only apply to multinational enterprises with consolidated revenues of at least 750 million euros. And that has to have taken place in 2 out of the 4 prior periods. So the thresholds are high, but there are many multinational enterprises that fall within these parameters. And obviously, where they do fall within these parameters, the impacts of Pillar 2 then drive down throughout the multinational enterprise group. And the application of Pillar 2 then comes in various forms. So the first is that you have what is referred to as a multinational top-up tax. And the multinational top-up tax is then implemented through what is referred to as either an income inclusion rule or an undertaxed profits rule. And the top-up tax is really there to increase the effective tax rate in a period, or rather in a territory, to the 15% level. The second, the second component of this would be through the subject to tax rule, which looks to apply a minimum level of tax to payments between related parties through a withholdings tax. And that only applies where the source jurisdiction is below the minimum rate. And then we have what is referred to as the domestic minimum tax, which is fundamentally similar to the multinational top-up tax, but is applied at a local level. And this is often set at the 15%, but those rates, I mean, are territorial, so they set at a domestic level, so it could vary. And I'll go through how these are going to be implemented or not implemented from a South African perspective later on. So let's look at a very brief overview and the key points of Pillar 2. So firstly, it's a global minimum tax rate of 15%. It applies to multinational groups or multinational enterprises where the annual revenue is at least 750 million euros. And as I indicated, that has to apply in 2 of the 4 prior years. It is intended that it will apply to accounting periods starting on or after 31 December of 2023. Again, the intention is that there will be a single global base erosion return for the group. There are a number of safe harbors and exclusions that potentially could apply, and there are transitional rules that are based on the country-by-country reporting data. for those organizations that are required to file country-by-country returns. And again, if you look at the threshold of the 750 million euros, that is aligned with the country-by-country reporting requirements. The calculation is done on an entity basis in a territory, but it is aggregated by territory. So if you have more than one entity in a particular territory, you would do the calculation for each entity separately, and then you would aggregate. What is interesting, excuse me, is obviously the OECD needed to find a common basis in terms of which to do these calculations, and therefore the calculations are based on financial reporting information as a starting point. And then any shortfall that arises from those calculations is then collected, as indicated previously, through the income inclusion rule, under tax profits rule, or the domestic minimum tax. So how's the calculation done? And this is an incredibly simplistic slide. The document, in terms of the factual calculation released by the OECD, in terms of the guidance, is in the region of 200 pages. So this is very simplistic, but at least we'll give it a fairly good overview of how you go through the process. So firstly, you need to obviously determine the entities in the group that arise in a particular jurisdiction. You then need to determine the profits of those entities. You determine the taxes that relate to those profits. And interestingly, that takes into account, when you work through the mechanisms of the calculations, timing differences that arise, or for those who are more familiar with the accounting terminology, tax adjustments that arise through deferred tax. You then aggregate the profits and the taxes that you determine through steps 2 and 3. You divide those aggregate taxes by the aggregate profits to calculate the group's effective tax rate in a jurisdiction. So it's on an aggregate basis, not on an entity basis. And then if your effective tax rate is below the 15%, you then calculate the top-up percentage for the jurisdiction, such that you get to a 15% jurisdictional effective tax rate. Then, flowing from that, you calculate the jurisdictional top-up tax by taking that profit, and you deduct a 5% return on tangible assets and payroll expenses in that territory. And that is what is referred to as a substance-based income exclusion. So they're giving you that adjustment on the principle that the entity has proper substance within the territory. And once you've calculated that, you multiply that by the top-up percentage. As soon as you've then determined that, you then attribute that top-up tax to the group entities in the jurisdiction, and that is based on a relative contribution to total profit. Then the top-up tax is first charged under the income inclusion rule, and the concept of the income inclusion rule is that it, in principle, places the obligation on the entity, on the parent entity of the multinational enterprise to settle that top-up tax. So in other words, it's done on a top-down basis. And then to the extent that there is any remaining top-up tax that is not collected under that income inclusion rule, that is then charged to the individual group entities, either under the tax profits rule or the domestic tax rule. So that's in a nutshell the process. As I say, the underlying calculation within the determination of all of those profits and the taxes relating to those profits are relatively complex. Yeah, it's I think just in terms of dealing with the calculations, you're looking at around about a 60-page document which sets out the various adjustments. So not something that I can cover in 30 minutes, but hopefully this just creates a little bit of awareness around how this process works. So really, when we're looking at Pillar 2, it needs to be embedded in your governance and reporting processes. It flows through tax compliance, transfer pricing, country by country reporting, financial reporting. So firstly, obviously, there needs to be an assessment as to whether organizationally you're going to be subject to Pillar 2. Whether as an ultimate holding company of a multinational enterprise or alternatively as a constituent entity of a multinational enterprise. Because as soon as you fall within these provisions, and probably in the majority of cases, as far as our client base is concerned, it's going to be at the constituent entity level. But as soon as you fall within these provisions, you really need to consider addressing both governance and reporting processes to make sure that you're dealing with what needs to be dealt with. So where are we in South Africa? So South Africa is committed. We have ratified the multilateral instrument, and that means we're in. We have chosen to be part of this international community, and that means that implementation of both Pillar 1 and Pillar 2 is certain. As I indicated earlier, Pillar 1, we have no legislation at this point in time, and there's no indication as to when we may or may not see that legislation. But when we look at Pillar 2, we now have draft legislation which has been issued by the South African Revenue Services. So let's look at that. So Global Minimum Tax Bill, this was released post the budget speech by the Minister of Finance at the end of February. So it is relatively recent. And I'm going to address some of the issues that arise because of that. And the first of those issues is around the intended effective date. And the intended effective date is the 1st of January of 2024. And the intention behind the Global Minimum Tax Bill is that we will introduce the global anti-base erosion model rules into South African domestic law rather. And the objective is to ensure that large M&E groups pay a minimum level of tax on their income in respect of every jurisdiction where they operate. And the proposals are as follows. Firstly, that we will introduce a multinational top-up tax at the rate of 15% on the excess profits of in-scope M&E groups. What is interesting from a South African point of view is that the imposition of this top-up tax will be applied using only the income inclusion rule and the domestic minimum top-up tax. There is no intention from the South African Revenue Services to apply the under-taxed profits rule and the subject to tax rule as mechanisms for collection of the top-up tax. So it's going to be limited to the income inclusion rule and the domestic minimum top-up tax. The bill does define what constitutes an M&E group, and fundamentally that is aligned with the international definition. So it is defined as a group with at least one entity or permanent establishment. And I think that that is a very important concept to understand, So permanent establishment doesn't necessarily mean that you have a registered entity. But again, from a South African context, you would probably find that the most common form of what we refer to as a permanent establishment would be an external company or a branch. So those are included in these definitions. It's a group with at least one entity or permanent establishment that is not located in the jurisdiction of the ultimate parent entity. Any member of an M&E group is referred to as a constituent entity. The consolidated financial statements are used to establish the entities within the group. So in other words, what you will find commonly when looking at these definitions is if you're an entity that is not consolidated, you quite potentially will fall outside of these pieces of legislation. And then your in-scope M&E groups are those groups where annual revenue is of at least 750 million euros, again, at least in 2 of the 4 fiscal years. The fiscal year is determined by the year that is covered by the consolidated financial statements of the entity concerned. So just keeping in mind, 750 million euros, obviously in a South African context, is a significant threshold. But as I indicated previously, you might be a subsidiary. When you start looking at worldwide revenue, that 750 million euros is quite often triggered. So how does it work in terms of the South African context? So firstly, you apply a minimum tax of 15% on the excess profits in each jurisdiction. And this concept of excess profits is as determined by the global rules. And then where those profits are taxed below a minimum, again, we get back to that 15% principle. So step 1 is to determine an effective tax rate by jurisdiction, again, in line with the global rules. Step 2, if your calculation of that effective tax rate is below the 15%, then the M&E group is required to pay a top-up tax to get the tax paid in the jurisdiction up to that 15% minimum. And as indicated, that's only calculated in relation to the excess profits. To determine your ETR, you just take your adjusted tax of your local constituent entities, again, aggregated, and divide that by the total adjusted profit of those entities. The global rules set out the detailed rules on how this is done. There are numerous adjustments that take place. Your base starting point is your accounting profit as per your financial statements. And then there are a number of adjustments that take place in order to get to that point where you can establish what your excess profits are and what taxes are applied against those to determine that effective tax rate. And then your top-up tax payable is simply the difference between the effective tax rate and 15% multiplied by the income or loss in the jurisdiction as calculated in terms of the global rules. How do we declare all of this? Obviously, you can only work this out after financial year end. What is indicated is that filing will be required of the global information return within 15 months after the fiscal year end, or 18 months if it is the first fiscal year commencing on or after 1 January of 2024, but before 1 January 2025. At this point, we have absolutely no idea what format this will take, whether it will be incorporated within the annual income tax returns, whether it will be a separate information return. So we wait with bated breath to find out exactly what the form and the mechanism for filing of this return will be. And then, the basic imposition of the top-up tax, so your income inclusion rule, and that looks to tax the domestic entity of an M&E group on all its allocable share of top-up tax, arising in respect of the low tax income of any foreign group company in which it has a direct or indirect ownership interest. And in principle, the income inclusion rule places the onus on the ultimate group holding company as a mechanism to settle that top-up tax. But then you kick down into the DMTT, and what that does is that it imposes a joint and several tax liability on the domestic entities of the MNE group to pay that top-up tax. So fundamentally, when you look at the legislation, you have both mechanisms which can potentially be used by the South African Revenue Services. So if they're unable to collect through the income inclusion rule, they will then collect through the DMTT, and the principle will then be that your domestic constituent entity will become liable for the top-up tax in terms of that. So these are really, so when we look at income inclusion rule and DMTT, these are just really the collection mechanisms that will be applied by the South African Revenue Authority in terms of the collection process. The calculations and the manner of determination will be in terms of the GloBE rules that were issued by the OECD. So what are our problems? And I've really looked at this in the context of comments that were made by the South African Institute of Chartered Accountants, SAICA, in terms of their submissions that were made to National Treasury around the implementation of the bill. And the first is obviously the implementation date. Given that the bill was only published and released for comment post the budget speech in February, to have an implementation date of the 1st of January of 2024 somewhat flies in the face of the way that South African Revenue Services and National Treasury have applied legislation. Because really what we're looking at is the implementation of the legislation is likely to become retrospective. And you have MNE groups with financial year ends of 31 December of 2024 who are on the assumption that this legislation will be applied retrospective to the 1st of January 2024, already subject to it, but there's no actual legislation in place because the legislation hasn't been promulgated. So this is fundamentally flawed and problematic, and is really not the way that our legislation has been applied over the last number of years in terms of the application of retrospective legislation. The second fundamental problem is that the GloBE rules have introduced two new tax acts. So they've been, or rather two new acts, which are separate from the Income Tax Act and the Tax Administration Act. And it's not really clear how these are going to interact with those two acts in particular, and probably more fundamentally around how they'll interact with the Tax Administration Act. So that's going to be interesting to determine in terms of what the link is there. And then the last particular problem is around the mechanisms that are being applied by South Africa in terms of our income inclusion rule and DMTT, that there's no real clarity on how these will interact with double tax agreements. Where we might have DTAs where different rules are applied, and then you end up in a situation where there is conflict. So there are a number of concerns, but the biggest fundamental concern is obviously that this legislation has not been put in place, has not been promulgated, and therefore it becomes very difficult, both from the perspective of being a tax advisor, as well as obviously being someone subject to this legislation or potentially subject to this legislation, to factually plan, to understand how to implement, and to understand whether or not this is going to apply to you or not. As we know, very often we see draft legislation, and when the final legislation comes out, it's not necessarily the same as that draft legislation. So very difficult for us to advise. But I think fundamentally, the first point of consideration that everyone needs to make is, does our MNE group fall within these provisions in terms of the thresholds? Secondly, do we fall within these provisions in terms of the thresholds and the rules? And the one thing that I haven't mentioned is that there is a de minimis exclusion. So potentially you could be excluded in terms of the de minimis exclusion, and that de minimis exclusion is set at thresholds where the constituent entities globally revenue is below 10 million euros, or alternatively its income or loss is below 1 million euros. Again, those are fairly significant thresholds. But that has to be the first point of call in terms of just making the assessment as to whether you fall within these provisions or potentially fall within these provisions. If the answer to that is yes, then what needs to happen is you need to engage with, obviously, with your local tax advisors, as well as the relevant tax people within the MNE group at a group level, so that you can look to put in place mechanisms that will address these rules sooner rather than later. Because the fact of the matter is the legislation will be introduced. The question is whether or not it will be backdated to 1 January of 2024. So thank you, everybody. That is the end of the presentation. Thanks very much. Appreciate your time. Bye-bye.